And as the president, as you can see, that news headline appeared to say yes when asked if the UAW should get a 40% raise. That headline nearly an hour ago could have been what pushed us towards session lows. We've recovered, but the September swoon is in full effect as the major averages continue adding to those recent losses. The Nasdaq down more than 6% this month, 9% off of the high from late July, almost in correction territory, even with a still 25% gain on the year. Microsoft, Apple, and Nvidia having the biggest impact on the Nasdaq. Nvidia down nearly 15% in September. But our next guest remains fully invested into the end of the year. Peter Andersen is Chief Investment Officer at Andersen Capital Management. And you're not in those stocks, are you, Peter?
Yes, I do own NVIDIA, and I've owned NVIDIA since almost the day I was born, frankly. So I've been through some rough times with NVIDIA in the past, and this is no different from those past rough times.
You have a kind of the Warren Buffett punch card approach here, or why not sell at some point and go, okay, it truly can't get any better than this?
Well, I think you have to focus now on interest rates and this whole narrative about higher for longer. And I've actually switched that to higher forever because I think a 7%, mortgage rate is a equilibrium rate. It is just that we've kind of forgotten, Kelly, prior to 2007, those of us that were around before then, interest rates were higher then, and we still had market rallies, and technology can still do well in a higher interest rate, despite the mathematics behind that we've heard ad nauseum about higher interest rates.
But Peter, let me just
values discount the stock price.
I'm glad you brought this up because if you said, well, 20 years ago, interest rates were at these levels. Well, 20 years ago, we almost had a budget surplus. And the budget picture couldn't be worse right now. I don't really understand how it's going to get solved. Does that make this time different? Because we could potentially have kind of yields spiraling for the wrong reasons and for reasons we haven't really had to confront before.
Well, I think the path that we took to get here is extraordinarily different. When you look at the history of interest rates and stock market performance, et cetera, these past COVID years were something that no economics textbook is going to prepare you for. So it is different this time, but we also have to have faith in the fact that, it's risk and return, companies that are going to achieve excellent results regardless of what the interest rates are. I mean, I was joking with a friend the other day saying, do you think NVIDIA, for instance, in their C-suite, do you think they ever talk about making investment decisions or corporate decisions based on what the Fed said at the latest press conference? I don't think so, and I hope they don't. But that gives us a little bit more of reality about, the balance of this. We have to focus on the economics, but it isn't all we need to focus on.
Let's talk a little bit about the persistence of higher rates. I mean, you and I are certainly seasoned enough, note my word choice there, seasoned enough to remember when a 6 or 7% mortgage rate didn't seem all that outre. Now it does. What is the effect there long term if rates settle at these higher levels, inflation settles at a somewhat higher level than the Fed's 2%?
I've thought about that a lot, Tyler, and at first I'm thinking, well, if that is the equilibrium rate that we've had in the past, so be it, and we can have economic rallies. However, I do think the impact is on residential real estate. When you were paying a 7 or 8% mortgage, you didn't mortgage as much as you would have to now. So I think it's going to cut out a lot of lower income people that just will not be able to afford the payments. So that's the main thing. But other than that, I think companies will chug right along. I think we will see more acquisitions, more M&A activity. Again, with the idea that I imagine in the C-suite offices, they're not talking too much about, gee, should we postpone this acquisition because rates are at 7 or 8%. I don't think that that's happening. I think it's more based on the strategic analysis of companies combining with each other and the outlook for the products, frankly.